Hello guys, welcome to Miscellaneous UPSC. Today we are going to know about these important things, that is monetary policies of India. First, you should be knowing about this economy. What case people feel about this economy is filled with innumerable numbers, but that is not true. Basic understanding with economy will lead you to good enthusiasm over this economy because all these are interconnected. Okay, all these repo rates, CRR, RRR, all these things will have a linkage. If you try to know the linkages, you will be trying to apply them in the real life. So now we will know how we are going to apply these monetary policies to our life. That is the thing. Because whatever the policy they are going to bring, I mean, monetary policy committee will form its committee for every 2 months, right? And they will decide how we need to increase this repo rate, and they will be coming up with a expansionary stance, neutral stance. What are these things? Calibrate stance. They will be coming with these stance. What are these? They have a actual meaning. They decide our life. Whatever the loan we are going to take, they will be deciding. These are the things which decide whole Indian economy. Okay, this is the thing. There are two type of policies which happens in any country. One is monetary policy that is decided by central government, and this is central bank. Okay, central bank, and physical policy that is by central government. Okay, that is the thing. We will be knowing about this monetary policy. Okay, so how central bank, that is our central bank is RBI, Reserve Bank of India, make changes in this monetary policy. Okay, what are the components present in this monetary policy? What are the tools? What are the types of tools? How, in which tool repo rate, CRR will be coming, SLR, all this will be we will discussing today. Okay, first, see why a monetary policy is important for a nation, because see how Ronaldo has just kept aside this Coca-Cola, which resulted in $4 billion lost to this Coca-Cola, right? Whatever they say, they will impact other dynamics. Okay, they are dynamic in nature. So whatever the things happen in one part of the world will directly show a some counter effect in some way. Similarly, a policy which is decided by few people will change the entire economy. You see, even suppose if this person is there, right? He is a billionaire. Let us compare with Mukesh Ambani. Suppose Mukesh Ambani sneezes, what will happen? All the shares will fall, right? All the shares will fall. There will be incredible change in the stock market. In that way, even the monetary policy will also change. Suppose you must be seeing, right? Whenever a monetary policy committee has said I mean, the governor releases its meeting details, all the stock markets will change, all the shares, all these securities will change. That is how this monetary policy plays an important role. Okay, next, what is a monetary policy? Monetary policy is a macroeconomic policy. Why this is a macroeconomic? Because a single thing is affecting whole India, right? A person who is sitting in Delhi releases a meeting. I mean, the meeting thinks what are the details happen in their meeting. So that will be deciding whole economy, right? Because the central bank will be holding some banks. These banks will be giving out loans. All the companies which are dependent on these loans are dependent on banks. Banks are dependent on the central bank's decision. In that way, this is a macroeconomic. Macro means whole, designed by central bank of a country to manage money supply. This is the important activity of this monetary policy. Okay, important. Money supply, interest. Both are complementary to each other. I will explain how they are complementary. It helps shaping variables such as inflation, consumption, savings, investment, and capital formation. Okay, capital formation means nothing but building of factories or buying a new equipment in a factory like a machine, new machine. In that way, monetary policy plays an important role in price stability, that is inflation. We will know how it controls inflation, how increasing the repo rate will decrease inflation. All those things we will be discussing in next slides. Economic growth, job creation. How job creation? Suppose if you reduce repo rate, so banks will reduce loan rate. So what will happen? Banks will reduce loan rate, that is interest. What will happen? So many companies will come forward to take loans and create job, social justice. This is how whole things goes. Okay. See, and in this monetary policy, there are tools. So like controlling tools of liquidity, that is supply of money, inflation. All these are controlled by few tools. So these are called as tools of monetary policy. One is quantitative and qualitative. What is this? Quantitative. Quantitative, you're understanding that it is size. Okay. Qualitative means how qualitatively you are giving. Suppose in quantitative, that is amount. Okay, amount. Let it be X. This is the amount that is being distributed. Let it be a loan X. So what is this qualitative? Suppose this loan X is given to so many people, right? Companies, farmers, and SCs and STs for entrepreneurship, for, for self-help groups, right? So how you are giving, whether you are increasing so much of funds for companies, you are reducing for farmers, this quality, this this justice is called as qualitative measure. How you make these banks, you make these banks give the loans in a justice way, in a right way, just way, so that farmers will be getting benefited. All this poor will be all this poor will be benefited. Even the companies is benefited, rather than showing impartiality towards these farmers, giving more loans to companies. This all will be controlled by these qualitative tools. Okay, next. So in this qualitative and quantitative tools, there are so many subdivisions. This is important for us. And in few exams, what they will directly ask, they will give options. They will give A, B, C, and they will ask what are these categories. Suppose let it be in an exam. They have given you choose the quantitative tools. So they will give options A, B, C. So what will be the answer? Options of quantitative, that is A and B. It's simple, right? Just remember these things, okay? Whatever the way you follow, just remember what do you want to write them, copy on the paper, or else mug up, whatever. These are important. You just need to remember these things because they're given directly, okay? That is the thing. So today we have learned these things. So these are the classification of monetary policy. Fine. Okay. Next, let me clear all these things. Fine. So in quantitative, what are the things? Reserve, reserve ratios, that is CRR, cash reserve ratio, and statutory liquidity ratio. These things we will be reading in the next slides. Okay, so reserve ratios are present in quantitative tools of monetary policy. Next is open market operations. You must be knowing about operation twist. Operation twist belongs to this thing, open market operation. So what are these things we will be knowing? The most important thing is repo rates, repurchase rates, reverse repo rate, bank rate, marginal standing facility, liquidity adjustment fund facility. What are these things? We will be knowing in the next. These are the qualitative types. Most important thing is you must have know about this priority sector lending. Priority sector lending is giving more loans for farmers, a startup, women, education, for economic development, development in a society so that poverty decreases. That's the thing. These are the types. Okay, remember this thing. So till now we have known. So from above table, this is the brilliance question. Okay, see in the above question, what you have seen in monetary policy, these two are what? Quantitative, quantitative type of monetary tool. So see which of them are the part of monetary policy. Only two. One, two. Option C. Because these two belong to, just don't confuse. We did not discuss about these things. So simple we can keep this belong to physical policy. All these things belong to physical policy. But we did not discuss. Simply you can, by knowing a monetary policy tools, you can keep this answer simple. See, these types of questions are given in mostly in CDS and CSC. Okay. Next, before going to this quantitative tools, that is repo rate, CSR, CLR, SLR, we should be knowing about basic definitions, basic terms. These are the basic terms you should be knowing. Okay. First is bond. First we should be knowing about bond. A simple question. Ask to yourself, what is a bond and a share? Okay. What is this? Ask to yourself. Simple. Bond is like a loan. Loan with with a note. This is a bond. You must be going to a notary and writing a bond, right? In a similar manner, this is a bond which says that after, see, I'm taking X amount of money from you as a loan, and I will be giving you by percent of interest for 5 years. Okay, after 5 years, the person who has taken this loan will be giving you the whole money and taking back this bond. That's the thing. What is a bond? Share means, suppose this is a company. The company's parts is divided into small of units. Those are share. The money which you get from share is called dividend, monthly dividend. In bond, you will be getting interest. See, the person who has taken loan from you has said that I will be giving Y amount of interest every year, or let it be yearly, monthly, it depends. Okay, but only for 5 years. After 5 years, he will be giving you over the principal amount and taking back the loan, and whole contract in between you will be cancelled. So hopper, that's the interest, dividend. Remember this. Next, government security. Just apply this bond to government. If a government gives bond, asks for you loan, that is government security. See, government security is a tradable instrument issued by the central government or state government. It acknowledges that government's debt obligation. That is, I already told, the person who is taking a loan will give you a paper, that is a bond, that I have taken you this much amount of money and I will be giving you this much amount of interest regularly. That is the thing. Simple. So both the things are given by state government and central government. In India, what happens? State government will be also giving this securities, government securities, and central government will also giving you this government securities. Okay, but RBI take case of central government. Means he will be like an administrator over this G6. Even he will be a administrator of state governments, but state governments need to ask, hey Prabhu, give some services for us also. In that manner they can ask, please, please deal with our securities also. They should ask. That is the thing. Rather than he will be not taking. Okay. His central government's primary, RBI's primary duty is to deal with central government securities. Okay, that is the thing. Next, state government has to request. So means there is no legal obligation on RBI to take care of state government's securities. So state government need to request the RBI to take care of this G6. Okay. Next, important thing here comes. See, what is the difference between G-Sec and tertiary bill? G-Sec is G-Sec's date duration is more than year. Its duration is less than year. Here you will get interest. There is no interest. No interest. Why there is no interest? So suppose government asks you 1,000 rupees. Let it be government takes loan of 1,000 rupees from you. From you. Government will take. Government. Okay. It will create a bond in the name of 1,000 rupees. Okay. Actually, what it creates a bond. First, I will check this number so that you will get a good understanding, because how it actually that government has taken 950 rupees. 950 rupees. Okay. It creates a bond of 1,000 rupees and gives you 1,000 rupees when the duration completes. It has taken 950, but it is giving 1,000 rupees after duration. That is the thing. Okay, there is no interest, but see, here you can see, for example, a 91-day treasury bill of 100 face value, this is the face value, may be issued at 98 rupees, that is discount of 1.2. So actually you are giving 950, but you are getting 1,000 as a face value. That is the thing. So no interest. So this is the thing about this thing. There was a previous, this is a previous year question. See, Reserve Bank of India manages and services Government of India security. Yes, but not any state government. Yes, I already told, state governments have to go and request RBI to take care of their security. So this is correct. And important thing, friends. See, G6 are given by state government and central government. But treasury bills are given only by central government. States government will not issue these treasury bills. Treasury bills are issued by the government of India, and there are no treasury bills issued by the central government. Right? No issuance of these treasury bills by the state government. This is right. The treasury bills are offered at discount rate. I already told. If your face value is 1000, actually you are giving 950 as a loan and getting 1000 in the return. See, you are giving a discount of 50 rupees and getting 1000. So this is right. 20. Okay, friends. This is the thing. Okay. This is let it this knowledge dissolve in you. We will be continuing our monetary policy in the next class. In the next class, I will be telling you about CRR, cash reserve ratio, and statutory liquidity ratio. Okay, that is the thing. I hope you like this video. If you like this video, hit the like button and share it with your friends.